Well, good morning, ladies and gentlemen. I just want to thank you for all joining us for this very special lecture this morning by Professor Merton Miller from MIT.
Robert Merton.
I'm sorry. I made some small mistake. Well, he is a very distinguished Nobel laureate in economics. I'm sure it's worth for you all getting up early to join us to share his enlightening views and illuminating insights. I'm especially thankful to Professor Miller for making special efforts. I'm sorry, Merton. Yes, it's a bad habit, repeating the same error.
Good habit. Good person.
By the way, there is another Nobel laureate by the opposite name. But anyway, out of his very, very tight schedule, he made a very special effort to come to this lecture and to meet you all. And I don't think I will waste any time since it's very precious time. So I will just stop here. I don't want to make any more mistakes and errors. So I will ask Chairman John to proceed. Thank you very much for joining us.
Good morning, ladies and gentlemen. As Dr. Sagong has just said, this is truly exciting morning for us to have a very distinguished speaker for our breakfast forum today. It's always tough to introduce someone who doesn't really need introduction. I have one of those cases today, but please allow me to say a few words about his very exceptional credentials throughout his career. More than anything else, Dr. Merton has received a Nobel Prize in Economics in 1997. That's the time when Korea faced foreign exchange crisis more than 20 years ago. He got his Nobel Prize thanks to his contribution to the development of a new pricing model for derivatives. And he's widely recognized as a true leader in applying financial theories, science, into practice, especially in the area of portfolio management, portfolio investment, and risk management field. He has been distinguished professor at MIT Sloan School of Management for many years, and university professor emeritus at Harvard. Dr. Merton is currently this resident scientist, that is special advisor more or less, at Dimensional Fund Advisors, which is one of the most influential and highly recognized investment firms in the world, with $600 billion under management. And by the way, the executive chairman of Dimensional Fund Advisors is a very well-known person, David Booth, who made a huge gift to University of Chicago, changing University of Chicago Business School to Booth School of Management. Now with that, ladies and gentlemen, let's welcome Professor Merton. He will speak for how much time?
40 minutes.
Yeah, about 40 minutes. And then remaining 20 minutes we'll open the floor for questions and then answers afterwards. Okay?
Thank you. I have to put the watch up here because, as you all know, professors like to talk. And among professors, I'm known as a talker. So I need the discipline. Well, it's a very, very great pleasure to be here with you, and thank you for inviting me and for that lovely introduction. And by the way, Merton Miller is a very fine scientist, and I am quite happy to have that. There are many such stories, but thank you. So let me, because of the timing, it's fair for me, having collected you all here today, to sort of say, what am I going to try to talk to you about in the relatively short time I have? And my topic is suggested by the title. I'm going to look at the finance industry, that's my expertise. And it's an important industry, not in and of itself, which is quite large, because a well-functioning financial system is essential to economic growth and development. And so it plays a very special role within our broader society. Now, innovation, financial innovation in particular, but innovation in general, is a critical driver of growth. And secondly, innovation means change. I was speaking yesterday with the chairman about how should you go about thinking about assembling, the information you need to do a big new project, like a new retirement system or something, very big, or in your company. I believe often the prescription is find out best practice, collect all the best practices, and then put them together to go forward. I would say to you this morning, as my opening remark, best practice is not good enough. And because I'm talking about innovation and change, let me give you the illustration. If it's best practice, what does it mean? Exists. It's being done in your steel plant or in your chemical plants or wherever else. Therefore, it's a legacy. Now, my metaphor for why I say best practice is not good enough, imagine I'm driving down the highway, and I'm driving pretty fast because it's, but I'm worried maybe I'm going to be intercepted. So I'm looking in the rear view mirror, right? So I'm driving. And then I realize I've been driving at 30 meters a second looking in the rear view mirror. Well, think about it. Now, if what's in front of me is the same as what was behind me, that works. Yes? But if what in front of me changes, and I'm riding this way, that doesn't work at all. That's my metaphor to you in innovation in general. Innovation is about change. The future is not the past. And if innovation is happening rapidly, then you have to be looking prospectively at not the way it's done now, best practice, but how it can best be done. It has to be practical. How could it best be done knowing what we know today, looking forward? So I use that just as a predicate to you to say what I want to talk about is the forward moving in the finance industry. Now, all of you are, I'm sure, aware of the big pushes, the big excitement in finance about bringing the power of technology into financial services, digitalization of everything. FinTech is the title for it. And the story that's told out of my country, Silicon Valley, not finance people, but technology people. If you're in financial services, you better start retooling for another job, because technology is coming to get you, and we are going to take over all the things you do. Between AI and all the technology, your days are numbered. Not just you as people, but your companies. Now, it's a bit of an older statement, but I think if you've listened to talks like this, you've probably heard that. And what I want to do today is give you, say, an insight into a somewhat different narrative for the future of this industry. And I only come here to show this to you, not to tell you what to do. That would be silly on my part anyway. But to show you something and see if this narrative helps you to think a little differently than we started this morning. So that's my introduction. Oops, what am I pushing? Oh, you can't read this. Fortunately, you don't need to. By the way, these slides are available to anyone who wants them, in case you want to remember something that was said. So if it's too small, I'm not going to go through each of these detail. But I do want to show you one picture. Pictures always work. This is from the 12th century, financial innovation. Not technology, financial innovation. 12th century to today. Well, what you can see is the speed of innovation has not been constant. Huge times between it. Today, things are happening very, very rapidly. That's to underscore how the world is changing so much more rapidly and why we need to call so much more attention to thinking about change and analyzing it, not waiting and reacting. So I also see this as optimistic for my profession and field, the financial industry. All of this rapid change, properly done, will greatly help society. I mean, let me make no doubt about it. Properly done, the digitalization of finance has enormous opportunities around the world for improving things. And particularly, those who are not getting good financial services now are going to disproportionately benefit from it. So those parts of the world, those parts of society who are not being served well, the opportunities to improve it for them are disproportionately better. So that's a very definite plus. I want to be clear. So that's to do it. Now, the theme that is in the title, and will be my theme this morning, that is left out of the Silicon Valley story, is trust. And trust is going to turn out to be a fundamental characteristic, a fundamental need in the success for the future. And that's been left out of the analysis. So my first statement is, technology by itself is not sufficient to create trust. That's the first statement. And I'll show that to you. Okay? That is implicitly assumed in the Silicon Valley story. They say, we give you this wonderful Samsung Galaxy Note, and we connect it up to Google. Okay, Google answers any question. I give you this, everybody will trust this and do whatever it tells them. That's the implicit assumption. Now, what is a substitute for trust is transparency. We all know what transparency means. If something is transparent, it doesn't create trust. It's a substitute for trust. You don't need to trust if you can see things perfectly, everything. Verification is different from transparency. Something may be completely opaque, but if I can verify what it does, even though I can't see what it is, that's okay too. So trust, which I'm going to spend almost all of my time on because it's at the center, the substitute for trust is transparency, because then you don't need the trust, or verification. So what we determine out of this is, when we look at fintech and its prospects for the future development, there are some areas of financial services that it will go very rapidly. It will go through and become very quickly adopted, just like the hot knife through butter. Those areas will be in such as calculations, processing, payments, record keeping, blockchain, if you want a buzzword, okay, for doing it. Anything that can be readily tested and verified. My prediction is it will go very rapidly into success. And in any activity in which transparency can be adequately substituted for opaqueness. So if we can make it transparent or we can verify, no problem. The Silicon Valley story is, I think, accurate. But there are going to be whole and very important areas of financial services for which fintech is going to have a lot of challenge. And we need to address that if we're going to get the benefits of the fintech. And that area are those activities which I call inherently opaque. We know what's opaque, okay? Inherently opaque means it's opaque and you can't make it transparent. It's not that you don't, you can't. Such areas that are very important, okay, are going to be financial advice, complex financial products. This technology that facilitates it. Financial advice requires assumptions, analysis, and so forth. You can't make financial advice transparent. So in those areas where you have inherent opacity, you can't make it transparent. You either have to have verification, which I'm going to talk to you about, or you must have trust. And if you must have trust, then the issue becomes, how do you acquire the trust? And the issue for the industry and for the individuals are, who has the trust asset? Who will bring that part to the evolution that counts? And how are the economic benefits distributed between technology and the trust asset? That's my theme for you this morning. Okay? Now, if there's no way to verify, then you don't have a choice. Trust is it. Now, I have various ways of showing it. I've already showed you my Samsung technology, right? Very fancy. I confess, it's not a 10 yet, but it will be, okay? Very well known and respected name in technology. Okay, Google, you all know what that is. Google, you can ask it any question. So I say this morning, what should I invest all my wealth in? In 12 seconds, it comes back and says, Bitcoin, 100%. Do you think I will do that? Would you? If you had your machine told you that? I don't think any of you would, right? Put your hand up if you would. My point. But this is great technology, great name in technology. It gave you an answer very quickly. So, by the way, I think your decision not to do it is a good one. So don't, Why? I'm asking you, why, though, are you unwilling to accept it? And the answer is that everything we do, whether from our head, from computers, from AI, is a model. I don't want to go into philosophy. There are no complete models. So all models are abstractions, simplification of complex reality. What does that mean? When you build a model, whether it's just one in your head or in a computer, you have to make assumptions, abstractions. What do I leave in the model, and what do I have to include? Those are judgments. There is no scientific formula for making those judgments. You can be informed by information. It's what I call the art of the science. And it applies to physics and chemistry as much as it does to economics or anything else. You have to make a good model is good abstractions for the job you're trying to do with the model. And that's what makes a good model or not. And that artwork is what goes into the model, and that's what makes it difficult to accept what this tells me. Because I don't know what model was used when Google gave me that answer. Maybe it was the most brilliant model that we know in society of the world for making financial analysis. Or maybe it was some kooky thing off the internet, or maybe it wasn't even Arnold at all. It was just a sham. I don't know that. This is opaque. I don't know what's in here. What else do I don't know? Models need data to feed into them. What data was used to give me that advice? Was it incomplete data, biased data, dirty data, or maybe no data at all, just made up? I don't know that either. And what else do I don't know? What was the motivation for the model and data that was used by whoever put this together? Not the machine. You understand, I'm not talking about the electronics. I'm talking about what the machine was working with, the thing that gave me the answer. What if it happens to be some entity who very much wants to sell their bitcoins? That may be good advice for them to give to me, but it may not be good advice for me. So 3 points. Everything's a model, and therefore judgment to model. Number 2, every model uses data, and it's therefore how good it is depends on the data we use. And 3, what is the motivation for the choice of model and the data? And if you don't know that for important decisions, that's why I would claim you wouldn't do it. Okay? Now, I could have given you a, do 62% in equities and 14% in fixed income. That would sound more reasonable. But you have no idea whether that's good advice either. I just used the Bitcoin to get your attention. So something is missing. By itself, technology isn't traded. And by the way, I won't point to which ones, but I see there are people in the audience. You're all a young group by my point of view. I see people in the audience who are millennials. Now, we've all heard, well, the older generation, they're afraid of this. They don't understand. But the young millennials who've grown up on this, and they trust technology. I was watching. None of the millennials in the room put their hand up that they would put 100% in Google. So don't confuse facility or familiarity with technology with being trust. Don't confuse those. Now, let me say, okay, well, if technology isn't by itself trusted, and we need to have trust, how do we, or what is it that we need? Now, there's verification, right? That's the way. Now, for example, let's say you hire me as your financial advisor. I'm not suggesting you would want to do that, but if you did, this gentleman in the front, you hire me as your financial advisor. I start managing your portfolio today. Question, if you had an AI machine, the smartest calculating, completely rational, no emotions, and you said to that machine, how long would I have to manage his money before he could verify that I'm a good or bad manager to a level of significance that's appropriate? Do you understand? It's like asking the question, if you do a drug evaluation, what level of significance would you need to approve a drug? There's a statistic for that. It's called the T statistic. Don't have to know what that is. How long would I have to manage your money, just looking at your portfolio, no other information, before you could get a t-statistic significantly enough, not very high level, pretty low level, not enough to get a drug approved, but significant. How long would you have to manage your portfolio? 5 years? 1 year? Well, let me show you some numbers here. If I had a 10-year track record, not too many people do, or the bottom one is a 30-year track record, which almost no one has. What it says here, if you want to be able to know at the end of 5 years whether I'm a good manager, this is the AI machine answering you, not an emotional answer. I would have to lose you 7% a year for the next 5 years, each year. Or I'd have to make you 37% a year, each year, for the next 5 years. Do you understand? That's the range that would have to happen before you would know, before the machine would say, he's a good manager, he's a poor manager, to that level of significance. If I manage it for 10 years, it gets a little better. But I'd have to at least lose 3% a year for 10 years. 10 years, remember. Or earn you 33%. I'm not going to go through all the numbers. What's the message? In a cold, calculating way, you may not like it, but this is what your AI machine would tell you with its cold calculations, because the statistics are the statistics, you know. You can't verify, or let's put it difficult. It's extremely difficult to verify financial performance. That's why if you have something like Alibaba or WeChat Pay, you know, the pay system, that's a black box too. Nobody really knows what's going on in Alipay. But what can you do? You can try the payment, right? It goes through. Your friend tries it, it goes through. So you can verify pretty quickly a payment system. Don't confuse success in that sort of thing as predicting success in financial advice. Because I've just showed you the AI machine is going to say, well, it's going to take 5 or 10 years minimum. Actually, it's probably going to be longer. So I want you to get from my remarks that verification of performance following financial advice, and it doesn't just have to be portfolio management. It's any kind of advice of this sort where you have judgment, sincerity, and you have as much uncertainty and noise as you have in things like the stock market, the currency markets, and so forth. There's nothing special about money management, okay? So verification is off the table. Well, it can't make it transparent, and if it can't verify, then you're left, you have to have trust. So what does that say? We have to, fintech to succeed has to get trust somewhere. And fintech, if it succeeds, will enhance the value of trust. Trust will become more valuable with technology, not less valuable. Why? Well, let me give you a quick example. This gentleman who I'm your advisor, okay? When I was doing your analysis for you, I would go a spreadsheet. Half my day was spent doing spreadsheet to figure out things for you. He's selling technology. He comes and says, Mr. Merton, here's a calculating machine, a very sophisticated. It can do, put his data into it. It will do all the analysis that you spend all day doing a spreadsheet. It'll do it just like that, and you can spend the rest of your day doing more productive things. The problem is, how do I know the machine he's giving me is going to take your data and give me the right answers for you? Well, what could I do? I could take all the spreadsheets that I did for you for the last 10 years, put it into the machine, see the answers, and say, hey, it gives the best answers, and when it's different, it's more right. So I can verify, even though I can't see transparently. You have chosen me as an advisor. You trust me. Maybe you shouldn't, but you do. So you trust me. I'm willing to use the technology because I can verify. And that's how the technology gets to use to you, in my view. Okay? So that's how it can work. But you need me to be the trust to you because you have no way of knowing what's coming out of the machine. And so I am valuable to you because I provide the trust. And I don't have to be a person. I can be a company. I can be whoever creates a government, okay? So that's my statement to you. Now, trust. When I say trust, most always people think trustworthy. I trust my grown children with my life if I can't make a decision. I trust them. But I wouldn't let any of my grown children manage my money. Why? They're trustworthy. I absolutely believe they will do the right thing for me. But they aren't competent. They are very smart and they're very successful, but they aren't financial experts. So I won't trust them, not because they're not trustworthy, because they don't have competence. Always remember, trust has two parts, trustworthy and competence. In my example earlier, the competence was the model and the data. The trustworthy was the motivation behind what model and data were picked. They are different, and you need both to have trust. All right. Now, what do I believe? I'm giving a forecast here. I believe that whoever possesses the trust asset, however they get it, will not only not disappear, but will be enhanced. If I can do for him much more or at a lower cost because of this technology, then I not only can service him, but I can service you. And you know what? Even though all three of you become my clients, he doesn't lose any trust for me. Trust is scalable. The fact that you also go or become my clients doesn't reduce the trust for him. This is not like IPO. You know, if I have a bunch of IPOs, if I give them to him, if I take you, I'm going to share them with you. He doesn't want that. Trust is something that you trust me, you tell your friend, you take your friend on, I can give him trust, you still have the trust. So it's scalable and expandable. The technology will not take my work away, my job away from me or my clients. It'll give me more clients. I will leverage my trust asset. So that's a very different story, I think, than the one that you hear about the replacements. And this applies also to financial institutions. The same idea, the institutions will be gone. So I wanted to point out to you that I think it goes exactly the other way if you have the trust asset. And the question is, what can we do to acquire that? Well, that's what entrepreneurs are going to figure out a way to do. I'm not going to tell you I have a magic formula how to create trust. I have ideas, of course, but I'm not going to do it. But I want to show you the importance of that asset, and without it, you will not be able to succeed in these areas. Even blockchain, you've heard them say, you don't have to trust it. Of course you do. Blockchain is a model, and which model of blockchain is used is going to matter. And blockchain uses data, and what data uses matter. And somebody designed that whole thing, and the motivations for why they did it, maybe they put a trap door to take all your money. That's trustworthy. So no matter what the technology is, you don't get away from this, and it's important to do. Now, I don't think I have to tell you that at least in my country, but I think in many countries, 2008, 2009 crisis, trust in the financial services system was lost, damaged greatly. It was not just in the providers. I won't mention names, but I have to. Wells Fargo, 3 million accounts that people didn't know about. That's not trustworthy. We heard executives, senior executives of some of the largest institutions didn't understand the risk in their business. That's incompetence. About regulators, regulatory capture. I'm not saying that's truth. I'm saying you've heard those stories. That's trustworthiness questioning. Then you hear the regulators didn't have the resources to understand and monitor the things that they were responsible for. That's incompetence. And that has had a big impact. And I want to show you a number. I have only a few more minutes. I want to show you a picture This is a survey done this past year by the CFA Institute, a very credible global financial analyst, okay, of retail investors and institutional investors, what's important to them in services, in investments, and how satisfied they are. What you see here, if you can see the picture, I guess you can, is full disclosure of fees and costs. Very important. Very important to retail and very important to institutional investors. They want to know what the fees really are and what it's costing them. Satisfaction, institutional investors, pretty highly satisfied. That's the right picture, if you can see it. I apologize. Okay? Retail, very poor. So it's important that they understand costs and fees. Are they satisfied with what they're getting? No. That's evidence of lack of trust. Second one, generates returns similar to or better than target benchmarks. Are you a superior investment manager? No surprise, very important both to retail and to institutions. Satisfaction, institutions, quite high. Retail, not good. This is data, these are data, I'm quickly showing you to suggest, hard data, that the retail part of financial services really isn't very happy with what they think is important to get. Institutional is okay. So it's not everyone, it's not because of the crisis per se. Now, what else I want to show you is one more piece of data, and I'm going to give you a story for this data. These are actual data, these are real numbers. This is the growth from the time of the crisis in mutual funds, which are what they're called indexed. They're passive funds. They don't do any decision making. They have mechanical rules. And the rules are specified and completely verifiable. You understand? You must all have heard of indexing, Vanguard, things of this sort. They're mechanical and they're completely specified. Therefore, I can verify that you're doing it and I can verify the returns. That's not a problem because I know exactly what you're doing. You're not doing anything active, no judgment. ETFs, very similar. About $1 trillion, the upper line is about $1 trillion of net flows into that over this period. And you can see it's steadily and still going on. Question is, why? And where is it coming from? In the lower picture, which sadly doesn't show here, I apologize, it's coming from active managers, active mutual funds, ones who say, we can outperform, we have smart people, better models, whatever. The opaque part of the business. About the same amount went out. So I would suggest to you, we all know trust was lost. The question is, what's the magnitude and impact of that? If this is a correct interpretation of why this happened, it's very big. So I'm trying to give you hard evidence, at least as a hypothesis based on the data, that what I'm describing to you is not a small factor, but a very important one. Because in 2007 or 8, some people believed nobody can beat the market. They invested in passive already, Vanguard or someone like that. Others believed that they could find managers who could do better. Two beliefs, that's fine. But now we see big flow away from the managers who can do better, supposedly, to the other. Why? I don't think it's because they suddenly woke up one day and said, I don't think those managers can make me the returns anymore. It might, but that would be very, very coincidental. Remember, we've had 10 years of bull markets. This is not reaction to fear or anything. But what happens? Suppose you believed that there are active managers that can do better, and you were investing, but you lose your trust in them. Now you can't use them anymore, right? Because you need trust, and you don't have it. You've lost it. What's your second best guess? You still have to invest your money. You can't stop investing your money. So you say, well, if I can't have trust, then I'm going to do what Warren Buffett said would be okay for his widow. She could put her money in index, she'd be all right. I'll do the second best. That's an interpretation. Not that they wanted to, but by loss of trust, they were forced to go to what's feasible. So, one last thing as I'm looking at the time, I do have one more minute at least, okay, is the role of regulation in trust. For those who represent government or those who work with the thing, regulation is a fundamental and key element to creating trust. In the drug areas, we buy drugs, we trust our equivalent of the FDA that they've tested these things. It's opaque to us. We take those pills. We don't know what's in there. And it's very important, right? So we have ways of creating trust about that, and we have ways of creating trust about opaque financial services. That is the role of the financial service regulating. And if we do a good job of it, it will do much to make confidence and trust and effectiveness of the system. If we do a poor job of it, we're going to be stuck with very suboptimal outcomes. So I wanted to mention on the trust area with thing, there's a triangle of here are the customers for financial services, us. Here is the provider, and here's the regulator. Boom, boom, boom. We all understand between us and the provider, you need the trust. I've talked about it. We also know that the provider and the regulator, the consumer, us and the regulator is important. We rely on the regulator to help us. So that's from us to the customer, to the provider, from us to the regulator. But there's a third leg of the triangle between the regulator and the financial service provider. If we can build that trust, which I'm afraid, certainly in my country, has been badly damaged, if we can restore the trust between the provider and the regulator, we can have a much, much better system. Why? Because the providers are the people that have the knowledge of what to do. You cannot expect the regulators to have the resources and the people that can understand as deeply as the providers doing what the providers are doing. So if we can build the trust triangle in all elements of what we do, not just along one of them, I say to you, this is an important strategic objective to make the system better and to make the country better, because a well-performing financial services industry in itself is important economically, but it is part of the fundamental infrastructure for the growth and development of your economy. So I'll end on those points to take the question to simply say, trust as an asset. You'll notice, and we all were taught we should be trustworthy coming up. I mean, thinking of it as a strategic asset. It's a barrier to competition, price competition. He trusts me. You offer him the same services lower. He can't see that your services are really the same as mine. He will not leave me for you. Okay? You get the point? So I think it's one of those things that works for everyone. It's optimizing for the good provider who has true content, true value to add. You want transparency. If I'm an A student, I don't want to be pass-fail. I want to see the grades because I want the people to see I'm an A student, not maybe a C student. If I'm a C student, I like pass-fail. If I am a first-class institution providing services, I want that to be known. I want that to be seen. I don't want that to be made opaque. Thank you.
Thank you very much for your brilliant speech this morning, Dr. Merton. Before I open the floor, perhaps I may say one thing. That was, after our schedule has been set with Dr. Merton, I had made one request to him. That was, please don't use sophisticated equations over breakfast. That may be a little too hard to be digested. And thank you very much. You followed my suggestion this morning, and and he spoke in plain language, but with very profound message. I think we all should appreciate what he told us about the financial innovation, fintech, and trust observations on the future of finance. With that, I would like to open the floor for your questions directed. Okay, Daniel?
Daniel Shin, MCM. Thanks for the great lecture. So 2 questions. Now, not that many people really like the volatile market, but there are many man-made twists, especially coming from the political economies in Brexit, and then I wouldn't even go over too much about the U.S. situation, but general Fed sentiment and then current leadership in the U.S. could be different, but market also sees that as opportunity, but at the same time also threat. So really, how does the systematic way to get that to be buffered? That was my first question. And then the other question is, to me, the broader definition of fintech also giving an opportunity to the access data, information, at the same time, really kind of reduce the cost of transactions too. So many good opportunity for people, ordinary people who are investing into the market. But in generally, like fintech, what does it really do to reduce the economic inequality? If you have some perspective, that'll be great.
Okay, well, 2 questions. The first was to do with all the uncertainties out there. I feel very comfortable in this room, seeing the people in here and knowing who you are. You've been around long enough. Has there ever been a time where there wasn't some uncertainty, fear, or something that could happen in the world? That's the norm. That's reality. Recessions, depressions, unemployments, booms, etc. That's the way the world is. This fiction is somehow we can stabilize and make everything safe and is a fiction. So we can't, it's like saying I don't want it to rain because then I don't need a roof. I can't control the rain, and no one, no banks, no central banks, no governments can control the forces that are in the economic system. And therefore, the important thing is not how do we get rid of it, we can't, but how do you measure it, manage it, and address the realities that there's a lot of uncertainty, and therefore you have to have a system with flexibility, options, to be able to respond to events that you could not predict. Okay, so that's the opening remark, and that's where I am. This is about dealing with the fact I can't make it transparent, so don't tell me make it transparent. Solve the problem that's reality. Okay, so how can we do that with what we have? I think we have very good tools, and I think we need to bring them to bear. There's no question that the data scraping and all of the technology can give us much more information. And that gives us the opportunity to manage better. But we will not get rid of the risks. We'll be able to manage them more effectively, design our institutions, our companies, our production processes with flexibilities, whether it's supply chains. Finance covers all of that because finance is all about one thing, uncertainty. You take uncertainty away, and I can teach you all of finance in 2 hours. It's the time value of money, and the only instrument you need is an overnight treasury bill in a world of certainty. Because you don't need insurance, right? Because you know the whole future. So all of finance, that's what we do, is to deal with that which we cannot forecast, that which we cannot control directly, but we can manage and develop our systems to successfully do it effectively. And that we can do very well here. The financial system, when it has all these variations, the world financial market is one, yes, it's all of us buying and selling. It is an incredibly complex system. To ask someone, tell me why the market went up or down yesterday, I have to say to you, that's ridiculous. I know we all ask it, but it is a very complex thing. You're all making decisions here, people are making decisions. All of it comes together. Something happens in Europe, it affects Asia. The idea that that complex system can be described by two-liners, the Fed did this, is going to ease or not. Does it have some impact? Yes. Does it have some impact for a short time? Yes. Is that how you run your businesses? No. So that's my first comment, is be realistic about what is there and recognize we have enormously powerful tools that properly implemented can improve the efficiency and effectiveness. It will not get rid of the uncertainty, and neither can any central bank. They can do things to help a little, but we have to deal with that ourselves. Now, the second one was the inequality. That was actually my reference at the very beginning of my talk when I said, I think FinTech has enormous opportunity and potential to improve things economically for people. And then I added the qualifier, I thought its benefits would disproportionately go to those who are not now being well served. So to the extent that you talk about inequality, I don't know how to transfer wealth, to more evenly or something. That's a different discussion. Important one, but a different one. What I can say within this world is, if we can provide people who don't have financial services with low cost, high quality services, they will benefit immensely. The people in this room, let alone even me, a teacher, I can go to a screen in my office with JP Morgan and I can transfer money to Singapore or anything, and I'm just a teacher. And I can do it rapidly, fast, and they don't even charge me. They charge me somewhere, but they don't charge me for it. And I get screen prices on the currencies. You're not going to improve on that for me, and certainly not for you. But for people who are trying to get money from Malaysia back to the Philippines, or for people who have no banking services or that sort of thing, this is a godsend if it's done correctly. What I wanted you to hear this morning, one piece, to have the opaque parts done, the advice parts, which you know is important, or complex products. That's a form of advice, right? You don't know what's inside these complex products any more than you really know what's inside your car. You know how to turn on the meter and drive it. You don't know what the internal combustion engine, you don't know whether they save 50 cents on brake calipers that might break at 70 miles an hour. I mean, you just don't know that. So in the area, for everyone, but particularly for those who have fewer resources, as you say, the inequality, having high quality and means of getting a trusted services and advice will help them enormously. And I remind you, and just from a cold value maximizing point of view, when I used to look at, the Forbes 400 wealthiest people, and they published that. My president seems to want to be on that. I don't. Anyway, when I look at that, you see Bill Gates or Warren Buffett. But you know who else is on there or was on there? All the Walton family, widow Walton and children Walton. Each one of them on that list. And when you added it all up, it was more than either Mr. Buffett or Mr. Gates. Who is that? Walmart. Who was Walmart serving? The vast bulks of people. I only mention this to say there's a lot of attention saying, providing service to high net worth people and big institutions, which is important and valuable. But there are an awful lot of people. So from a sheer profitability point of view, sheer value creation point of view, if you can create value efficiently and exploit it in those markets, doing the right thing, not doing the wrong thing, you, in my view, can create more wealth than doing technology or some of these other things that are much more expensive. So those are my two answers.
Thank you, Mr. Kim.
Thank you, Dr. Merton. Your very philosophical presentation of the story. This was the most eye-opening talk I have had in a long time. In that regard, I'd like to ask a question about some fundamental conflict of motivations in the financial institutions. The people who want to trust the money, give somebody money to be managed, of course, was the best results for the money. But the managers may not necessarily have that motivation. And I'll give you an example. When I had an occasion to oversee a major corporation's management of retirement fund, the manager who manages that fund was that, of course, he doesn't manage himself. He was hiring multitude of financial managers. And the way he was doing this is that each month he looks at the results. And occasionally, bottom two gets kicked out, and he hires new two. And he says, this is pretty much the same way as his colleagues in the other corporations do. So what it does is the managers who comes up making presentations to be hired by these corporations to manage the hundreds of millions of money, his motivation is not necessarily the best results, but his best ranking, such that he does not get into the bottom of that ranking. When there are occasions where it involves major risk, and if it's your own money, you would stay away. But in the meantime, until it comes to a cliff, it keeps on showing the results. If he stays away from it, from this month to the next month, he gets down to the bottom. And therefore, knowing full well if his money he wouldn't do it, he would be motivated to get into that. And that's one problem that I would like to ask you the solution a little later, see if there's a law of large numbers, and the fintech can solve that. Another one is the issue you raised at the outset. The future is not the past, but all those models and everything depends on the past. Now that's okay when the change of the pace has certain amount of stability. But right now we are at the time and the point where we have not seen the historical past. The things change so rapidly. I'm not so sure how much of the past is the good guide for the future. Thank you.
Thank you. Thank you for your question. And I wish I had a recording. I would like to take it with me. Everything you say, I agree with, but let me analyze what you've said. You've described a dysfunctional system. If you have fabulous hospitals, but you have incompetent doctors, you're going to have bad results. If you have a car that only starts 1 out of 4 times, you're going to be very angry about cars. Not because you don't want a car, because you want a car that works. And what I'm saying to you here, I'm describing some of the things here that you can't pretend are there. I tried to explain that this idea that somehow you can just verify, you can't in the services. So, 2 things. One, that's one of the roles in creating trust. From what you said, maybe I shouldn't use the financial services here, okay? But I need to. So we need to work to build my trust so that what you described isn't the way things are done. How do I beat that? That was my final point about, I believe here there's not a conflict for those who have real value. If you don't have real value, then you always have to fool people. If I'm a C student, I want a passing grade, so hopefully you might think I'm an A student. I could be. But you understand, I'm talking about people who have value to add, people who have real companies, who have real knowledge, who want to deliver serious services. Not all the things that are bad. There are most things people are not good at delivering. That's why we don't have them. So do you understand that's what I'm talking about? For them, I would say, and by the way, I won't mention which company because it was already mentioned, but the company that brought me here, and this is not an advertisement, but I can't, it's a private company, it was built from scratch. It never did any acquisition, it was all internal growth, okay? And it's, well, I would say it's great success, since I had nothing to do with it, I'm not patting myself on the back, was based on the idea that if you have something good, you know, real value, and the best strategy for the most money, to make the most money, the thing that you were referring to, staying in business, okay, is to build trust, however you do it. And if you don't have that trust, you won't be in that business. I've heard the stories you describe, and if it's a regulator or someone, you absolutely have to do it because there are bad people. That's why we have policemen. But that's very different from saying everyone is a criminal or everyone. It's not all about being policemen. You need policemen. But what you need to do is facilitate the good stuff by encouraging the right kinds of disclosure, by encouraging incentive systems, by imposing useful regulation for the purpose of getting trust. And yes, there's a role to be a policeman. Get people out who are not doing. Those of you running your businesses, I can't do anything about it. If you run a steel business based on what the output's going to be at the end of the month, and that's how you run the business, probably I'm not a steel person, but I'm probably not going to work very well. I can't do anything about it. If you have incompetent people, you get rid of them. If you can't get rid of them, you've got a much bigger problem. And fintech, and that's the other message, can do phenomenal things with technology. It will not do the things that you're referring to. Fintech is not somehow magically going to get rid of this challenge that you have, or this dysfunction of having short-term horizons. Okay? There are just some things that technology won't solve. We all like to believe there was a deity inside who will be all-knowing, all good, and will somehow make sure everything's done well. And there may be somewhere, but not in the financial system. And so my answer to you is everything you say is important. These are reasons to do this. The payoff to society as well to the individual entities doing it is you'll have much more efficiency, you'll be able to deliver those services at a better price, and you'll make more money. And that's one thing. It is not, in my view, a trade-off between doing the right thing and making more money. That's only true, in my view, when you have nothing to add. Thank you for that.
Thank you. As time is running out, perhaps one last question, Professor Kim.
Professor Merton, I greatly appreciate your insightful and inspiring lecture. Now, I have a very short question. One, you said a trust was lost in 2008 and 2009, and how long would how much improvement has it been? Has been done in the U.S. financial industry? And listening to your lecture, it comes to my mind that even if the trust is fully restored, say in the U.S. financial industry or any other countries, transparency is better than the trust. Is that all? What do you think?
Oh, well, you just said it. I began my remarks by saying the only substitute for trust is either transparency or verifiability. You say, isn't transparency better? Yes, if you can do it. What I'm saying to you is a fiction. I can't. You can put a lie detector on me. I want to tell you everything. I can't be transparent about my advice. It's just not doable. That's what it means to be inherently opaque. If you assume away, it's like assuming a can opener when you're stuck on an island trying to get a can open. If I have a can opener, it's an easy solution. If I can make it transparent, that's easy. Unfortunately, much of the high-value things that are done, not just in the financial services, but in industry, cannot be laid as transparent as needed so that you don't need trust. That's why I say a payment system, that will work because of verification. Other things, indexed investing, where you have things locked in and you can observe, that's transparency. You don't need to trust Vanguard. But you can't make everything transparent. And big swaths of what you do in this industry, not little pieces, not little side pieces, fundamental things like financial advice, like complex financial instruments, okay, cannot be made transparent any more than Kia can make their cars transparent to you. Even if they wanted to, they can't. So my first answer is If you can do transparency, fine. Then fintech will work very easily. And there are areas. But don't extrapolate a model that says because it works somewhere where you can have transparency, that you can have transparency everywhere. There we don't need trust. If there's no other message I give you, that model that you can do transparency and then everything, you don't need trust, I think is a very flawed model for the world. And so that would be my principal response. Okay?
Okay, thank you very much. Time is up now. A small announcement on behalf of Dr. Merton that he graciously suggests that anybody who wants to come forward to meet him, shake hands with him, or take picture with him, he will be happy to do that until the last minute. So please do so. And once again, thank you very much for your excellent speech this morning.
Well, thank you. But could I just...
Sure, yeah.
You know, if you get something for free, you often don't value it very much. So those who want a photograph, there's a price. And the price is, you have to send me a copy. It's very easy. Even I can do it. You get my email, you attach the thing there, and you send it. You don't have to do it today. Is that a fair deal? And now you've paid for it. Thank you.